You're not paying yourself back interest. You're not borrowing from yourself. You're borrowing against your policy. You're borrowing from another financial institution. There is always a cost of money. If you pay cash for something, there's opportunity costs that you lose. You lose the ability for that money to earn you. If you finance the car and you interrupt that compounding of the money, you're spending that money to a banking institution, a credit union, a dealership, whatever, GM Financial, like whatever, Jeep, whatever the banking institution is, you're paying the money to them and you're giving up control of that money. I've seen this work with people in their lives. Just in the way that you finance your vehicles, you could have $250,000 more at retirement just by improving the financial efficiency in your life. Hey, what's going on, cash flow hackers? It is Chris with Life 180, and for this video, I want to talk to you about policy loans, how they work, why they're so important, and when you understand how they actually function, it changes the way that you look at money. It changes the way that you make your financial decisions, how you make major capital purchases, how the flow of money in your life changes. And for all the people who listen to Dave Ramsey talking about why would you ever pay to borrow money from yourself, it makes no sense. This video is gonna answer all those questions. So before I get into anything else, because I got a spreadsheet I put together to kind of explain this concept, because I'm a very visual person. I see life on a spreadsheet. That's just the way my brain works with numbers. What I wanted to do is kind of make sure that you understand the lingo behind this, because there's a lot of YouTubers out there, there's a lot of influencers, a lot of agents that talk about this improperly. They talk about the concept of borrowing from yourself, paying yourself interest, and the reality is, I've done some videos on this in the recent past. Those are two terms that you need to just eliminate from your vocabulary. You are not borrowing from yourself, and you are not paying yourself interest, right? So I'm a big believer a confused mind always says no, and I'm also a big believer that this is the most powerful strategy in the world. And when you understand this, it's going to be a no-brainer. A light bulb's going to come on for you, and you're going to see this, and you're going to be interested in doing it. Now, when I say a confused mind always says no, when we use the terminology that you borrow from yourself and you pay yourself interest, that creates confusion for people. It doesn't make sense, and the reality is it's not logical, it's not possible, and that's not how it works. And so your brain and your emotions are fighting with each other. So if you're confused about this, I promise you by the end of this, it's going to make sense. Now, here's what I want to say. You're not borrowing from yourself. Let me counter that really quickly. So you're not borrowing from yourself. What you're doing is you're utilizing the cash value in your policy and you're collateralizing it. That's a big word that I want to understand, a key word, I should say. It's not that big of a word. It's a key word that I want you to understand. Collateralization. We all understand what collateralization means in a lot of different contexts. And so what I want you to understand is you're utilizing your cash value as collateral. The life insurance company on a contractual basis is saying, okay, based on the value in your policy, we're going to give you a loan whenever you want. Now, that's where the power in this lies, because remember, you're not borrowing from yourself, because if I was borrowing from myself, I'd have to be taking money out of my policy. I'd be interrupting the compounding, right? It would work a completely different way, but that's not how it works. I'm collateralizing the money, borrowing against my policy. The insurance company's given me a loan. I pay interest to the insurance company in the form of simple interest, but meanwhile, the money in my account, my policy, is still growing. So I got a spreadsheet here, and I want to walk you through it. I'll explain this stuff because, like I said, it's a very visual thing. And remember, you're not paying yourself interest. There is an interest expense, and I'm going to explain that in the spreadsheet as well. And this is going to get really fun. So before anything else, let's just dive into this sheet. All right, so here's an example that I wanted to show everybody. The example that I'm using here is at the end of year 3. So this would actually be policy year 4. I should probably fix that, 4, 5, because we've saved for 3 years. This is the beginning of year 4, 5, and 6. So we've saved for 3 full years. At the end of policy year 3, we had $28,000. So we're starting off the year 4 with $28,000 in net cash value. This example I'm using is running an illustration that I did for somebody else, that the team did for somebody. And in that example, what we had was $10,000 of premium going in. You can see the loan rate with the insurance company is 5%. This is what Dave Ramsey loves to hate. Why would you pay interest to borrow from yourself? I already answered that a little bit, but we're saying you're going to buy a car, right? Like, so you saved up, now you want to use, you have $28,000 of cash value, you want to buy a car, and you want to use your policy to get that car. So what's going to happen is you borrow at the beginning of year 4, you borrow $20,000. And then as you go through the year, you're incurring simple interest at 5%. Simple math is $1,000 in interest. Now I'm saying that you're paying $5,000 a year on that. You can break it down monthly, you can pay annually. With a policy loan, there's no structure to it. You can pay that back however you want. If times were hard and all you want to do is pay $1,000 of the simple interest, you could do that. I don't suggest it, especially on a depreciating asset. If you had to do that on a cash flow producing asset, it can make a little more sense. But in this scenario, you want to make sure anytime you have a depreciating asset like a car, you want to create a system where you're making that payment of $5,000 and you're amortizing that and paying the insurance company back and increasing your collateral capacity, because this is a big thing. I'm not paying myself back, I'm paying the insurance company back, but as I pay them back, my collateral capacity increases. Because you could see here, $28,000, let me explain how this $12,000 works. I started the year off with $20,000, I took a loan of $20,000, right? So that means my collateral capacity, the amount that I have available to continue to borrow against in my policy, is the 28 minus the 20. That's $8,000. Right? So now what's happened though is out of that $8,000, I paid back $5,000. So that gets me to $13,000 because I've recapitalized my account, right? So as I pay back in, that money becomes liquid. But I did incur $1,000 interest expense out of this $5,000. So it brings me down to $12,000 of collateral capacity. So here's what's cool though. Out of this $28,000, it grew at a 5.25% dividend, right? 5.25%. So this is where it's really fun. My policy value is up to $29,470. And so year 5, I start off, now let's take it to the next level. I start off with $29,470 in cash value. That's earning the 5.25%, right? My loan rate remains 5%, but the amount is down to $16,000 because I paid the $5,000 minus the $1,000 expense, so that reduces the loan amount by $4,000. My interest expense for that year goes down because I owe less on it, right? And so I'm still making the $5,000 payment, but it's more efficient because now $4,200 is going towards recapitalization, only an $800 interest expense. My year-end collateral capacity is going up even more. It's better and better and better because now the cash value is also growing by more, because this is the power of compounding in the base account by never interrupting that money. I'm compounding on a bigger number and I'm paying less and less interest as the years go, right? So here's the power for this. 5% rate, 5.25%, you can see here up in this little thing, 0525. That's the 5.25 dividend, right? That I think is important for people to understand. And when you do that, this is just a 0.25% spread, and this is how powerful this really works out, right? So check this out. Like I said, you have an interest expense. You know, when they say, why would you pay interest to borrow from yourself? No, I'm paying the insurance company. That is the financial institution that I'm paying. So I am incurring $2,897 in interest expense. The key thing to understand, so now this car, the net cost of this car is $22,897. But here's the beautiful part. By doing this, like, think about my options. I could go pay cash for that car, $20,000, but I'm now losing control of that cash. The cash is going, the cash is just gone to the person who sold me the car. And at the end of that, the time when I need to buy my next car in 5 years, I either have to make sure I'm saving up for it again, or I have to have cash somewhere to buy it, or I'm gonna be stuck. I'm gonna be in a worse financial position later because I have a depreciating asset and I'm not gonna have enough money to buy a new car in 5 years, right? So this is the power of this, because now yes, I have this expense, but my policy has actually grown by $8,163 during that time. So because of the way that money moved, I took advantage of compounding, never interrupted the compounding. I paid the simple interest, took on that expense, and I have a net gain of $5,265. So rather than paying $20,000 cash for the car, I paid $22,000, but my policy grew by that. And so I actually had $5,200 net gain after the cost of interest over a 5-year period on that car. And so when you see how this can work with everything, that every vehicle, every item that goes through your life, any significant capital purchase, it's a big deal. But one thing that I want to come back to here is the loan rate, because full transparency, the loan rates with insurance companies are not the best always, right? Especially for items like cars and mortgages and stuff like that, right? Because anything where the bank can secure an item like the car against it, you can typically get a little bit of a better loan rate. So, okay, let's take a step back and talk about that real quick. So if you can get a better loan rate, well, then the cost of money goes down. One of the good things about a policy loan through the insurance company is that you get flexibility with a higher loan rate. It's unstructured. But what I'm going to tell you is you can use your policy as collateral no matter what. So even if you go to a bank, and I'm going to use this example, if you, like I have this as a new tab here, you can see the only thing that changed in this spreadsheet was the loan rate. And I have this as a cash value line of credit. You need to have at least $50,000 of cash value to pull this off. But even if this was a car loan rate, if I went through the dealership and I got a good promo loan rate of 2%, I'm going to take this because what's going to happen is my interest expense has dropped from the $2,897 to $1,061. What that does is improve the efficiency. Now, what do I lose? Well, I guess what do I gain? I now, instead of $5,200 of net gain, $5,265, I have $7,100 net gain with the policy growth minus the interest expense. But the cool part about this is even though I'm giving up the flexibility of the unstructured loan payments with the insurance company, because if I do this, I'm going to have a structured loan over a 5-year period. I have to make a monthly payment to the banking institution, right? And so that can be a little uneasy or stressful for people. But remember, when you do that, you actually don't interrupt the collateral capacity. You still have the full account value growing over here. So if your car payment was $400 a month or $450 a month, and you ran into a hard time and you needed you wanted it unstructured, you could borrow against your policy the same way, collateralize your policy just to make individual payments, and you would function the same way. You would pull in this higher rate, but you wouldn't be pulling the higher rate in for the full 20,000. You would be pulling the higher rate in simply for the small payments, and you would just catch up on those, at the end of the year or when cash flow is a little better. It would function the same way as an unstructured payment with your insurance company. So I hope that makes sense. So once again, you're not paying yourself back interest. You're not borrowing from yourself. You're borrowing against your policy. You're borrowing from another financial institution. There is always a cost of money. If you pay cash for something, there's opportunity costs that you lose. You lose the ability for that money to earn you. If you finance the car and you interrupt that compounding the money, you're spending that money to a banking institution, a credit union, a dealership, whatever, GM Financial, like whatever Jeep, whatever the banking institution is, you're paying the money to them and you're giving up control of that money. Utilizing this system, you are putting the money in there, right? And you're making the payments, but as you do, you're never interrupting the growth of the policy inside. And so you're creating that positive, what I call arbitrage, which is the spread. And when you understand, I could show you with a 5% loan, I did this example with a 5.25% dividend and a 5% loan. I could show you that if it were a 5% loan and a 5% dividend, because of the fact that one is simple interest and one is compounding, you're always compounding on a bigger and bigger number annually. And this, with the simple interest, the interest expense is getting less and less and less every year. And so just with that principle, I can show you, I've seen this work with people in their lives. Just in the way that you finance your vehicles, you could have $250,000 more at retirement just by improving the financial efficiency in your life. So, with everybody, if you're in your 20s, 30s, anything of this nature, the way you pay for college, the way that you pay for your cars, the way that you, pay for any significant capital expense in your life, maybe an air conditioning replacement for your home, or pool upgrades or something of that nature. All of those things fall into the purview of how this can increase your efficiency. So that's why I'm so excited about sharing the banking concepts and just utilizing a properly designed whole life insurance policy with people. That's why I'm so passionate about exposing the fact that people like Dave Ramsey are just trying to get this out there and not really explaining and articulating to people what the power of this is, and they don't understand it themselves. That's the only thing I can do, is give them credit and hope, give them the benefit of the doubt that they just don't really understand it, and they're talking about something that they don't understand. So anyway, if you haven't already, make sure you subscribe, hit the bell, that way you get notified every time I launch a new video. Smash that like button, share this video, get it out with people, because listen, we're in a world right now, God knows where the direction of everything is coming with inflation, with taxes, with everything. Your ability to take control of your finances right now and set yourself up to be as efficient as possible is going to have a huge impact on what the rest of your life looks like. I'm telling you, I believe that at my core. And so make sure you subscribe. Make sure you check in. I release a new video every single day, and love to have you part of the community. So until next video, I hope you have a blessed, inspirational day, and we'll talk to you soon. Take care.